The state of the economy today is deeply worrying. The last quarter's GDP growth rate of 5% signals that we are in the midst of a prolonged slowdown. India has the potential to grow at a much faster rate, but all-round mismanagement by the Modi government has resulted in this slowdown.
These are very serious comments made by a former Prime Minister who is also a well renowned economist. So let's dig down a little deeper to understand whether these comments make sense. In order to understand how our economy has been faring, let's look at some parameters for comparison. Let's take growth rate of the economy, size of the economy, inflation rates, trade and trade imbalances, and finally government debt as a percentage of the GDP. Then let's compare them to sample set of nations, major G10 nations with populations greater than 50 million, populous socialist European nations, BRIC countries, SAARC countries, and some Southeast Asian countries. So what we did here was pick a bunch of countries in the G10 such as the USA, China, UK, Japan, France, Germany, Italy, and Norway, Sweden, Denmark to represent the socialist nations in Europe, Russia, Brazil, South Africa from the BRIC nations, and Afghanistan, Pakistan, Nepal, Bhutan, Bangladesh, Myanmar from the SAARC nations, and Singapore and Malaysia for the Southeast Asian nations. And what you see here is amazing. From 2013 to 2018, India was the fastest growing nation, as you can see in the graph as well. Some countries, such as Bangladesh and Pakistan, seem to have larger growth rates for a brief period of time, but you will see that it's inconsequential when we look at the next parameter. The next parameter that we would look at is the size of the economy. And from this chart, you see that India is a 3.15 trillion economy, US is 21 trillion, China is 15 trillion, and so on. But many of the other countries, barring Russia and Brazil, have much, much smaller economies, and therefore, huge growth rates in small economy is not a big deal. It is much harder to achieve a higher growth rate in a larger economy. India is the fifth largest economy in the world with a 3.15 trillion large GDP. And you can see in this chart that India has 5% of the global economy. Barring the USA, China, Japan, and Germany, India is the fifth largest one, and everybody else is much, much smaller. The next parameter we would look at would be inflation. We would look at the last 5 years, starting from 2013 to 2017. In 2013, India had a very high inflation rate of 10.91%, which came down dramatically in 2014, and in 2015, 16, and 17, it came down to 3.33%. Because of where it started, the average inflation in India is 6.15% over the last 5 years, whereas the advanced economies and the European countries had much better inflation rate because they handled the supply side very well. But you can see from this chart that BRIC and SAARC countries had much higher inflation rates than we did. While our inflation rate is coming down, it's not as good as the developed countries, but significantly better than many of our peers. Now we'll move on to trade. What you see before you is the export level and import level of various countries, trade deficit, that is, import minus export, and a percentage of import over export. So you would see that India had imported 129% more than what it exported. USA had 146%, China 78%, and so on. What we see before us is that, barring China, Japan, few of the European countries, Russia, and Brazil, almost all of the countries have a trade deficit. Japan manages its trade deficit very carefully so that it doesn't anger the Western nations by exporting too much. Whereas China relies almost exclusively on an export model based on manufactured goods. Russia exports natural resources such as oil and natural gas for its trade surplus, as does Brazil. A big chunk of India's imports is oil and natural gas. Therefore, any fluctuation of oil prices in the world is beyond India's control and it balloons its import bill dramatically. Looking at this chart, you'll see that China sits on a very healthy trade excess of $475 billion and Germany as well at $297 billion exporting engineering goods. If we remove outlying countries such as USA, China, and Japan from the equation, as their GDPs are much higher than India's GDP, India does reasonably well compared to others except for Germany, Italy, and Russia. The final parameter that we would look at would be government debt as a percentage of GDP. India has 70.2%, USA at 107%, China at 65%, and so on. Interesting takeaways is that countries like Russia and South Africa have very low percentages of debt compared to richer countries in the G10, such as the US, UK, and France, have very high leverage levels. Yet another interesting story is that Japan has a very high debt to GDP percentage. It is at 236%. This is because Japan borrows heavily from its own citizens to fund its own projects. So while the percentage is very high, this kind of a leverage essentially pays back its own citizens for its own use. In summary, you see that India has 70% government debt of its GDP, sits very comfortably compared to other countries barring China and Germany in its GDP level category. So, what have we learned in the last 7 minutes? We found that India has the highest growth rate in the last 5 years compared to all its peer nations. In size of economy category, USA trumps everybody. And in terms of inflation, Japan has negative inflation, which is bad from an economic standpoint, or also good from a consumer standpoint. Russia beats everyone from its trade surplus and very, very low government debt. And how has India fared across these parameters? On growth, the average was 2.32%. India did 7.15. The size of the economy, the average was $5,249 billion, and India is at $3,155 billion. On inflation, the average was 2.82, India was at 6.15. On percentage of import over exports, India is at 129%, while the average was 98%. And on government debt, India is on 70.2%, and the average is 93.32%. On the whole, India has done well on growth rate and debt, but needs to do better on trade and inflation. One of the major stated goals of this government is to become a $5 trillion economy in the next 5 years. If India needs to do that, it needs to work more on these lines. However, a bigger problem remains, a problem of the past. Previous governments, led by the same Dr. Manmohan Singh, has left behind a series of bad debts from loans given out to friendly capitalists and looters. Some of them have run away and others still remain within the country. A large amount of money stolen by previous unscrupulous politicians have been stored in multiple tax havens across the world. Bringing them back would also make a big difference to the economy. To understand the gravity of situation on NPA, just watch the short video from the finance minister.
Loan recovery record levels have been reached. If in financial year 18, 77,000 odd amount was collected, 77,000 crores, now it's crossed 1,21,000 crores. That's about record recovery levels. then the gross NPAs, I want particular attention to be drawn of the media for this, gross NPAs have come down. So in December 2018, if you had 8.65 lakh crores, now the asset quality has improved, NPAs have come down, and the level at which they are today is only 7.90 lakh crores.
Admittedly, the economy has slowed down and it needs to be restarted and accelerated forward. The government has announced a bunch of new measures that it claims will boost the economy forward. Most of them are in the capital market space, taking back various measures that had instituted earlier. While these are good starting measures, the government really needs to look at how it's going to infuse a lot of capital amongst the banks, especially the non banking financial companies, which give out most of the loans in this country. While the economy is slowly moving towards a consumption based model, the government would do well to look at the Japanese model of borrowing from its citizens for its own projects, thereby infusing capital, kicking off new infrastructure will only go back to finance its own citizens and itself.